Good afternoon, and welcome to the Venable webinar, Minimizing Legal and Compliance Risk for Credit Furnishers. My name is Jonathan Pompan. I'm joined today by Alexandra Megaris and Andrew Bigart, all attorneys here at Venable in Washington, D.C. Today's webinar is on compliance risk for credit furnishers. Recent Federal Trade Commission and FTC and Consumer Financial Protection Bureau activity reflects an increase in scrutiny of companies that supply or furnish information to consumer reporting agencies, as required by the Fair Credit Reporting Act. Data furnishers, including merchants, debt collectors, and lenders, can reduce supervision and enforcement risk by avoiding the common mistakes the FTC and CFPB have identified in their recent enforcement announcements. But before we get into the details, first, a couple housekeeping items. Today's webinar is being recorded and will be featured on our website as well as our YouTube channel. Also, in addition to that, today's webinar is for CLE, for one credit in certain states. For those of you who are wanting CLE credit, stand by to the very end for the special code for the CLE form. We will be in touch with a form after the session, probably within 1 to 2 business days. And then also, too, please note that we will be having another webinar on January 12th at 2 p.m. Eastern Time on the CFPB Regulatory Outlook 2016. And an invite will be going out for that after Thanksgiving, but there is information already available on our website, which we'll provide a link to later today for information about that webinar. There is a registration engine as well. Although we don't have the ability to click through on the PowerPoint that you're viewing on the screen, again, that is on our website. So first up, I'll introduce our panelists today. First, we have Alexandra Megaris.
Good afternoon, everyone.
And Andrew Bigart.
Hello.
And both Andrew and Alex work on FTC, CFPB, and a variety of state enforcement and regulatory activity as well as compliance items, primarily related to consumer financial services companies, but also other merchants and companies that furnish information to credit reporting agencies. As a result of that work and activity, both on the supervision and in the enforcement side as well as compliance, all three of us as a practice have familiarity with these issues related to data furnishing. And data furnishing to consumer reporting agencies is unique because it implicates both activities related to consumer engagement as well as also some very strict statutory and regulatory requirements that are increasingly being enforced by federal and state regulators and also undergoing scrutiny too by the private plaintiffs bar. So we're going to discuss today an overview of the Fair Credit Reporting Act's Furnisher Rule. We're going to talk about the need and requirement to have accurate reporting, the investigation of disputes, regulatory expectations, and recent enforcement activity, and key takeaways from all three of us being in the trenches and in the field. The important thing to keep in mind with the Fair Credit Reporting Act Furnisher Rule requirements is that those requirements don't exist in a vacuum. They do also exist in a context of relationships, often contractual, with consumer reporting agencies by users and furnishers of information from the consumer reporting agencies, as well as also related to the underlying transaction with the consumer. As a result, the fact situations that you may encounter within your own organizations may be somewhat unique, although there's some similarity across the board, as well as also some functionality related to reporting and interacting both with consumers and the consumer reporting agencies that's typically similar across the board. So while we may be giving examples today about, for instance, debt collection activity or merchants, lenders, and others that are using and furnishing credit information, your own particular situations may be somewhat different, but hopefully by analogy you'll see some relevance and takeaways. So the Fair Credit Reporting Act's Furnisher Rule is something that is embedded essentially in the Fair Credit Reporting Act and as a result of 2003 amendments with the Fair and Accurate Credit Transactions Act, FACTA. Specifically, the Fair Credit Reporting Act, for those of you who may be new to this subject, was passed in 1970 to govern the collection, assembly, and use of consumer information by consumer reporting agencies and their customers, and provides the entire framework for the credit reporting system in the United States. In addition, of course, there's the 3 large consumer reporting agencies and a number of other smaller specialty reporting agencies. Furnishers are entities that report information on consumers to at least one consumer reporting agencies. That, of course, includes lenders, merchants, debt collectors, courts, and others. There's over 5,000 different types of furnishers in the United States, falling into all sorts of different categories. The credit reporting system is complex. It includes both consumers and lenders and the consumer reporting agencies, public records, and then a very sophisticated system of reporting between the entities that are involved in the process. This graphic here, which is actually a graphic that was available from the Consumer Financial Protection Bureau, illustrates some of the connections and relationships. For those of you who are on the ground at companies involved in e-Oscar reporting, which is the computer system set up by the consumer reporting agencies, for furnishing information directly to and from the consumer reporting agencies, you may be familiar with some of this, and in fact, some of the more complexity even behind the scenes. At its core, though, consumers all have consumer reports at each of the consumer reporting agencies generally, and as a result have information, in some cases different information, reported to each organization. Of course, that information is considered very specific and regulated by the Fair Credit Reporting Act, and the FACTA requirements related to furnishing govern the ability for consumers to contest and dispute the information that may be on the consumer report.
So one of the things that makes the Furnisher rule and the FCRA in general interesting and challenging at times is the fact that it does play such a big role in the consumer finance market and cuts across so many different industries. Just to give you a sense of the scope of this issue, each national consumer reporting agency maintains credit files on over 200 million adults and regularly receive information from about 10,000 furnishers of data. On a monthly basis, these furnishers provide information on over 1.3 billion consumer credit accounts or other trade lines. And as we have this quote up here on the slide from a recent CFPB report, and really the key takeaway here, and one of the reasons the focus of the CFPB and other consumer agencies is that most decisions to grant credit, including things like mortgage loans, auto loans, credit cards, private student loans, include information that are contained in credit reports as part of the lending decision. So the accuracy of the information in those reports obviously plays a huge role for consumers that are looking to take advantage of these different products and services. Another example of the scope of this issue, which we don't have up on the slide, however, is the number of complaints that are submitted related to credit reporting to the CFPB's Consumer Complaint Portal. As many of you may know, the Bureau has a portal set up that allows consumers to submit complaints. And according to information that the Bureau put out in 2014, between about 2012 and 2014, 31,000 credit reporting complaints were submitted, basically in less than 2 years. And nearly 3/4 of these complaints were about the accuracy and completeness of credit reports. And these are really the core issues that we're going to touch on today when we talk about the Furnisher rule.
Now, Andrew, there's a lot of different regulations and sources of guidance under the Fair Credit Reporting Act. How do you keep them all straight?
Well, it can definitely be a challenge, especially because this is one of those areas of the law that touches on a lot of different industries, and that in turn can bring in a lot of different regulators.
And yeah, the different regulators doesn't make it easy either, right?
No. You're dealing, each agency has its own kind of culture and way of doing things. But essentially, rules have been issued by banking agencies, by the FTC, by the CFPB. They each have their own Furnisher rule. But fortunately, they're identical in substance, which does make it a little bit easier. The FTC has kind of a long history of issuing informal opinions on the FCRA and guidance, and more recently, as the CFPB has come online, the Bureau has issued a number of bulletins on credit reporting as well. In terms of enforcement, the FTC is still authorized to enforce requirements of the FCRA. Federal banking agencies can enforce it, obviously, with respect to national banks and state savings associations or banks insured by the FDIC. And the CFPB has authority over providers of consumer financial services and their vendors. Also, it's important to note that state attorney generals can bring actions on behalf of residents. Just to give you kind of a sense of what some of the potential penalties are, which aren't up on the screen, but just to let you know, the Federal Trade Commission, for example, can obtain $3,500 in civil penalties for knowing violations. The Bureau, the CFPB, has its own structure for penalties that comes in tiers, the first beginning at $5,000 for each day of a violation, and then going up to $1 million per day for egregious violations. And then also for more limited aspects of the FCRA, there are private rights of action.
And Andrew, in this circumstance too, and we're going to get to this I think a little later in our presentation, there's sometimes an overlap between the FCRA Furnisher rule enforcement and general UDAP, unfair, deceptive, or abusive acts or practices, if it's the CFPB enforcement, that can just ratchet up the cost here, even though there may not be direct consumer harm. How does that play out?
Yeah, I mean, that's something somewhat unique to the Bureau, given that the Bureau has broad, what they call UDAP authority, unfair, deceptive acts and practices authority, but it also has authority to enforce specific consumer protection laws and regulations. And what we've seen the Bureau do in a couple of cases, not just with the in the FCRA world, but looking in situations where a statute may apply, or maybe it doesn't quite apply, but the spirit is there, and using that UDAP authority to basically bring the case home. And that may happen, for example, where original creditors that aren't always subject to the Fair Debt Collection Practices Act may find similar types of claims being brought under the UDAP authority. So at this point, I think we're ready to turn to a series of slides where we kind of break down the Furnisher requirements. The key ones obviously are furnishing information that is accurate and complete, which we'll start with, and then turn it over to Alex in a few slides to talk about investigating consumer disputes about the accuracy of information that is provided. So it is illegal to report information that is known or believed to be inaccurate. Essentially, if you have a reasonable cause to believe that information is inaccurate, other than allegations from the consumer, then that's the standard basically for doubting the accuracy of information. If you furnish information to a credit reporting agency on a regular basis and determine that any of the information that you provide is inaccurate or incomplete, then you have an obligation to notify the CRA promptly, to provide corrections or additions, etc., and then going forward to furnish only the correct information to the CRA. The FCRA and the Furnisher rule requires that you furnish any information to a CRA. You must include the following items as relevant to the particular transaction at issue. Credit limits, disputed information. Once a consumer disputes information, you can't report that information to a CRA without telling the CRA that the information is in dispute. And as noted, Alex will talk in a few minutes about the obligation to investigate disputes. Closed accounts. If you furnish information to a CRA on a regular basis, you must notify the agency that a consumer has voluntarily closed the account the next time you send that information in. For delinquent accounts, when you refer an account for collection and you notify the CRA that you have done so, you also must report the date of delinquency to the CRA within 90 days. The date of delinquency is the month and the year the consumer's delinquency began. If you take an example that the FTC has provided in some of its guidance, assume the account becomes delinquent in March of 2015. The creditor places the account for collection in October of 2015. In that case, the date of delinquency is March 2015. The date that the creditor places the account for collection is not the basis for calculating the delinquency date. The date of delinquency is important because it determines how long the debt can be reported on the consumer's credit report. Generally, a reporting agency may report a delinquent debt for 7 years from the date of delinquency. If the debt was discharged in bankruptcy, however, the CRA may report it for 10 years. For debt collectors furnishing information about the accounts of a creditor, the collector must report the date of delinquency given to you by the creditor. Now, if the creditor doesn't report the date of delinquency, the collector in that situation has basically two options. You can establish and follow reasonable procedures to determine the date from the original creditor or another reliable source, or if you can't determine the date, you may establish and follow reasonable procedures to ensure that the reported date of delinquency is a date before the account was referred to collection or charged off.
And just a note, sorry to step in, Andrew, on the date of delinquency, as will become very apparent later in the presentation, this is really critical. The issue of re-aging obsolete debts is on every regulator's radar. Re-aging is essentially when the date of delinquency is reported incorrectly to reflect a more recent date, and as a result, it pushes out that 7-year reporting period later than it otherwise would be. And this most often happens when a debt is sold and the date of last payment or some other activity date is used as a date of delinquency instead of that original date of first delinquency, which is the correct date. And so agencies, especially the CFPB, are all over this issue. In every examination relating to credit reporting, they're asking very detailed questions about the credit report files submitted and how a furnisher determines what the date of delinquency is.
Alex, we're going to get into supervision, enforcement, that sort of stuff a little bit later, but when you're on the ground working with clients, prepping them for an exam or working through an investigation, you're seeing situations where the CFPB, particularly because in the supervision context, is drilling down on individual accounts and then tracing everything back step by step by step. And it may be part of a debt collection exam, but it also may be credit reporting solely that they're interested in, right?
I mean, that's absolutely right. So, I mean, any creditor, any lender, any collector, any company that has consumer account level information that also results in credit reporting in an exam context will inevitably have to produce account level information, and that will require a assembly of all the information that is maintained and submitted to the credit bureaus, and all that information then is scrutinized by the examiners and picked apart as to what dates were reported and why others were not, and based on a telephone call with the consumer that they listened to, why wasn't this activity instead reflected in either the account notes, the data, the system of record, or to the credit bureaus. So the CFPB is getting to the level of looking at specific transactions and seeing how that is incorporated in an organization's system of record, but also how that information is communicated to third parties, including the credit bureaus.
I think what's notable there for companies that are involved in that process and have gone through it, you've lived it, you know what it's like. For those that haven't, it's very different typically from what we see as what the monitoring and auditing process for an internal compliance program would have been, essentially either pre-CFPB or pre that experience, where they're looking at, oftentimes companies will look at things from the top down. And Alex, what you've described is folks are really looking from the bottom up, and therefore retracing steps and connecting dots that in some cases would not be caught by a systemic review of the reporting system within a company.
That's right, and as Andrew will touch on the next slide, but they're also looking top down. Especially in this context, the policies and procedures are the most critical piece of compliance for furnishing, because that's really what, it's not strict liability statute for reporting inaccurate information. It's having reasonable policies and procedures. I just wanted to make one other note on furnishing specific information. The elements that Andrew laid out are the ones that are included in the Furnisher rule, but there are other pieces of data fields that typically are reported on. And sticking with collections for a second, debt collectors should be reporting the original creditor name in the supplementary segments, which allows consumers to recognize the account, which could have the effect of decreasing disputes, but more importantly, it helps the bureaus connect trade lines so that they don't duplicate reporting. The credit bureaus have reported to CFPB, for example, that debt collectors often are not reporting that field, and the CFPB has taken notice, and so have other regulators. As many of you know, this past spring, the 3 national credit bureaus settled with a group of about 30-something state attorneys general, and one of the requirements in that order, which essentially overhauled a lot of the credit reporting function, but one of the requirements on those settling credit bureaus is that they require debt collectors to include the original creditor in that data field and to actually reject a credit file submitted if that piece of information is missing. And that's something that, for those of you that are impacted, are probably already starting to hear from the credit bureaus. That's a change as well.
Great, and that's great discussion. I think that kind of emphasizes 2 points. One, obviously, the requirements seem kind of straightforward when it comes to the Furnisher rule, but in practice, it can get very granular and complicated. And so it's kind of leading to the next point that it's important to have policies and procedures, not just because they're required by regulation, but because that's really the best way to be able to address those kinds of issues and make sure that you've got your system set up to be operating in the right way from the get-go. So under the Furnisher rule, certain types of policies and procedures are required in order to ensure the accuracy and the integrity of the information that's being provided. You can see them up here on the slide deck. I won't go through every single one of the requirements, but they're really what you would expect to see for a responsible kind of compliance program. It needs to be tailored to your specific business size, complexity, et cetera. There should be internal controls that are checking the information that's being provided, but also checking to make sure that the policies and procedures are working the way that they're supposed to be doing as well. They should address potential problem areas like re-aging, which Alex was mentioning just a few minutes ago as being really a big examination and kind of enforcement area of focus. And they should also make sure that the information that's being submitted is being substantiated by records when it's furnished. The substantiation requirement is something that is very important to the Bureau and to other agencies. Really, you need to make sure that you have records and documentation that you can use to confirm that the information that you're furnishing is accurate. And this question of documents and records is something that the Bureau has used in other contexts as well in terms of making sure that you've got the right information about consumers, and therefore the actions that you're taking aren't going to be unfair or abusive or deceptive for consumers. So I think with that, we turn it over to Alex or Jonathan if you have anything to add for a discussion of the investigation of disputes.
Well, investigations of disputes is important, but Andrew, let's go back and just touch for a moment on policies and procedures. The FTC in particular has put out a lot of guidance material about the policies and procedures, and now you've got the CFPB examination guidance as well. In work related to policies and procedures, are we often seeing companies that have really robust policies and procedures, or we're seeing room for improvement?
I think there's, you definitely get a range when you work with different companies, but I think that there's oftentimes room for improvement. And I think that the companies that tend to have the best compliance systems in place recognize that there's always room for improvement, and that they build that concept into their, what is called their compliance management system, so that they don't just get an off-the-shelf policy and put it in place once and then just kind of forget about it, but that they take the policy, they tailor it to their systems, to their business, and then they review it periodically. They review what the agencies and bureaus put out as best practices and new areas of concern. They check that information against their policies and procedures, and they update it as needed. So I think that the mindset needs to be that there's always room for improvement, and these policies and procedures aren't they need to adjust and change as times change.
Right. And now, Alex, a big part of policies and procedures is how a company handles and investigates disputes. What's a dispute?
So one of, I think, the most onerous requirements under the FCRA for furnishers is the obligation to handle disputes in accordance with the rule. Regulators consider this duty as a really important check or kind of a second line of defense on accurate reporting, which we just covered. The statute gives consumers the right to dispute the accuracy or completeness of any information appearing on its credit report with the CRAs or directly with the furnisher. So there are two kind of dispute paths that we'll cover today. The vast majority of disputes get routed directly to the CRAs, and to deal with the significant volume, the credit reporting agencies, I'll refer to them as CRAs, have developed a complex electronic system for intaking disputes from consumers, doing some preliminary vetting, their investigation, and then routing the ones they can't handle on their own to the furnishers for them to do their investigation. For debt collectors, kind of caught in the crosshairs of two different regulatory regimes that require very specific and different responses to consumer disputes. So there's the furnisher rule and what we're talking about today, but there's also under the Fair Debt Collection Practices Act, the requirement that collectors provide a validation notice to consumers and give them 30 days opportunity to dispute the debt or seek validation, substantiation of the debt. And those requirements are very separate but do in fact overlap significantly, especially because any type of dispute that comes in under kind of the FDCPA context would of course need to be reported as disputed debt in the credit reporting context. FDCPA also requires the dispute to be submitted in writing, so verbal disputes under the law are not required to follow these rules, although we're seeing the regulators push on that significantly. The FDCPA has a built-in 30-day validation window, right, where that obligation on the debt collector exists, but that does not, of course, appear in the FCRA. There is no deadline or time frame. And then oftentimes companies that we work with have struggled with distinguishing between disputes under the FCRA and requests for validation. And it's really hard to distinguish them at all. And oftentimes companies, just decide to treat everything under the more onerous of the requirements, which is probably the FCRA. So turning to, mentioned two different paths for disputes. We'll start with indirect disputes, and these are the disputes that consumers file with the credit reporting agencies. So just a little bit of background about what happens before the dispute gets routed to you, the furnisher. So consumers can initiate disputes with CRAs online, by phone, via mail or fax. And online, essentially, consumer enters in their information and then says, I want to dispute, and they have the ability to select a dispute, one or two dispute codes from a drop-down menu. I think there's 29 options available. And they can also enter in kind of a short, free-form text explanation of what's going on. On the phone, consumers essentially try to explain what they are trying to say to an agent of the CRA, who in turn attempts to distill the information into one of these codes, or two codes, and rarely, but can happen, they'll enter some sort of narrative in that free-form text box. After that dispute is taken in, the CRA runs the request through its own internal decision rules to see if it can resolve the dispute on its own. In 2011, which is the last time I saw stats on this, 15% of these disputes were handled by the credit reporting agencies without forwarding the dispute to the furnishers, meaning 85% of disputes that come in to the credit reporting agencies get routed to the furnishers. And I think a lot of you listening probably are surprised. Even 15% are kept by the CRAs. They don't seem to do very much vetting at all. So then you got 3 Oscar, which is a web-based system that connects you, the furnisher, to the CRAs, you receive notification of the ACDVs, the Automated Consumer Dispute Verification Form, which is the consumer's dispute and all the information that the credit reporting agency forwards to you about that consumer or the trade line and what the dispute is. The requirements on a furnisher are as follows. One, to investigate the dispute. And we're going to skip the investigation step for now because we'll spend some time on that. Second, to report the findings of the investigation back to the CRA that sent you the dispute. If there's updates or corrected information that result from the investigation, have to provide that to every CRA, but the FCRA does handle that for you. And have to make a decision about whether to modify the information that was initially reported to the CRAs, delete the trade line, or permanently block its reporting if it turns out to be inaccurate or incomplete. If everything checks out in the investigation and information reported was accurate, you can of course respond as verified as accurate. All this must be done essentially within 30 days. I mean, the ACDV should include the deadline from the credit reporting agency on how many days you have to respond. The credit reporting agency has 30 days to get back to the consumer because most of the time agencies are forwarding the ACDV to the furnisher instantly. You have 30 days to get back to the credit reporting agency. And the credit reporting agency is required to give you, the furnisher, all the relevant information it receives from the consumer within 5 business days of receipt, and any additional information that comes in. And we'll discuss that in, the role that plays in the investigation in a few slides. If you as a furnisher do not investigate and respond to the notification within the time period that the CRA provides to you, the CRA is required to delete the disputed information from its files.
Alex, the process that you've described is highly automated and computerized. It's very sophisticated, and it's been built on systems that have been in place at the consumer reporting agencies and oftentimes at furnishers for years. Is there a human factor involved in this too?
I mean, so on the credit bureau side, as I mentioned, many of the consumer disputes, I think maybe even at this point most, I mean, it's close. I think it's like 40-something% file online. The rest is phone or mail, and that the disputes that come in to the credit bureaus by mail or on the phone, and that requires a human to interpret what the consumer is saying into into a code and free-form text. So that that is a manual process. With respect on the furnisher side, how disputes are received from the EOSCR system and then handled is very dependent on the organization. Many companies, especially those that deal in high volumes, have automated much of the process, especially the receipt of the files, the EOSCR files, from the credit bureaus into their own systems so that they can process the disputes on their end on their systems. That's almost always automated. And we'll talk about the investigations as well.
Yeah, and that's, for folks that haven't taken a look at that system or process that they might have internally, it's that intersection of where the computer and automation hits the human and vice versa. That nexus is oftentimes where there are areas for potential issues, or certainly differences of interpretation with a regulator or enforcement agency, right, Alex?
I think the regulators take both. The regulators oftentimes see the benefits of technology and automation. It ensures efficiency and consistency, which is very important to all regulators. On the other hand, they oftentimes find that something that's very strict and rigid and doesn't take into account for things like human events, which is what oftentimes plague consumers that have issues with respect to the credit reporting. That if it's not flexible enough to take into account those type of situations, then it could be harmful. And when you think about the 29 dispute codes that a CRA or a consumer can select from, given all the possible variations of a consumer's situation with respect to opening or dealing with an account, you could see why an overly automated, stringent system like that could be problematic.
Well, let's change gears and talk about direct disputes.
Sure. So the later amendments to the FCRA gave consumers the right to dispute directly with the furnishers. The obligations on the furnishers are essentially the same. So first, you have to investigate the dispute, have to report the results to the consumer in this context, because the consumer contacted you directly. And then if you find that the information was inaccurate, you must notify each CRA to which you furnish the inaccurate information so that they update the credit files accordingly. Unlike disputes that are received via e-Oscar, the furnishers that receive letters to be written from consumers challenging items they see on their credit reports they can be vetted, can vet the request to ensure that it meets the furnisher rule. So unlike with something comes through e-Oscar, essentially the CRA should have vetted it, you have no choice but to do the investigation and respond. With direct disputes, you only need to investigate if the dispute relates to the consumer's liability for the account or debt. So for example, if the consumer's disputing whether that there might have been identity theft and they didn't open the account, or whether there's individual joint liability, or whether the consumer is an authorized user of a credit account. That's pretty typical. If there's multiple users on the account, which one's liable? Second, if the dispute relates to a term of the credit account. So for example, disputes relating to the type of account, the balance, or the amount of the credit limit, if it's inaccurately reflected in the credit report, that's something that a consumer may dispute and you would have to investigate. Third, if the dispute relates to the consumer's performance or other conduct on the account. So disputes relating to payment status, high balances, the date a payment was made, the amount a payment was made, etc. So when is an investigation of direct dispute not required? And this is probably the more helpful information. So the first handful of bullets essentially say you do not have to investigate a direct dispute if it relates to information that you did not furnish or that you don't really have responsibility for furnishing or keeping accurate. So biographical information, information about the consumer's employers, information that other furnishers may have provided, and then information such as public records. You're also not required to investigate the direct dispute if, one, you believe the dispute is submitted by, prepared on behalf of the consumer by, or submitted on a form supplied to the consumer by a credit repair organization. Some telltale signs about disputes that the FTC and other organizations have kind of given guidance on is if the disputes come on the same form, from the same address, or essentially all the trade lines are disputed in one letter. That said, it's pretty hard to tell. I know a lot of organizations just don't even attempt to discern those types of communications because it's pretty difficult to do so.
Alex, the reality is that consumers sometimes will have third parties help assist them with that process, right?
That's right, and that's not the same thing. So just the fact that a consumer is represented by an attorney, a credit repair organization, does not mean that their disputes have to be, are not valid. So it's really about the form of the document that's received. Second, the dispute is not submitted in writing to the address that the furnisher provides publicly provides as the address for where disputes should go. And so again, here, verbal disputes about credit reports do not trigger the FCRA obligations. And then finally, the big one, if the dispute is frivolous or irrelevant. And implementing each of these three kind of filters is risky. There's just not that much black and white guidance out there about what each of these things mean, and the risk of not investigating the dispute seems to outweigh the benefits, especially because most organizations in this space do not receive that many direct disputes as compared to the indirect disputes.
And Alex, obviously this applies about direct disputes, but the frivolous or irrelevant exception, carve-out, does not apply to indirect. Is that right?
That's right. So it's, like I said, with indirect disputes, there's really no kind of discretion. Those disputes have been vetted by the CRAs, and therefore you need to respond to them and dispute them. Just a quick note on frivolous or irrelevant disputes. A dispute is frivolous or irrelevant. Again, a direct dispute is frivolous or irrelevant if the consumer didn't provide enough information to investigate the dispute. The dispute is substantially the same as a dispute you previously received and you previously responded to in accordance with the Furnisher rule. With respect to the first prong, sufficient information, the Furnisher rule lays this out. It says a dispute notice must include sufficient information to identify the account, specific information the consumer is disputing, and an explanation of the basis for the dispute. And then third, it must include supporting documentation or other information reasonably required by the furnisher to substantiate the basis of the dispute. So, for example, copies of the credit report that the consumer is referring to, police report, if there's allegations of fraud, affidavit to that effect, court order, account statements, etc. If you do find that a dispute is frivolous or irrelevant, you don't have to investigate, but you do have to notify the consumer within 5 days of receiving the dispute that you are classifying their communication that way. And this notice can be a form letter, but it must include the reason for the determination and, if relevant, any information the consumer needs to submit. Unfortunately, generic notices that are kind of used in every scenario are under a lot of scrutiny. And so a lot of organizations have found that the burden of getting this requirement right, the notice requirement, is too high and not worth it, and therefore a lot of companies are just not, and I use this language, taking advantage of the frivolous or irrelevant dispute standard and instead just classifying all disputes as not frivolous or irrelevant. And there are pros and cons to both. But if you do choose to classify disputes this way, it's really important you have written, clear criteria that to consistently apply, to all disputes when something is frivolous or irrelevant. And then, of course, the notice that goes out should be carefully vetted by counsel. It's just a tricky area.
So, Alex, reasonable investigation, what is it?
There's really no clear standard. It's not set forth in the statute or the rule. Instead, it's been shaped by court decisions and regulatory actions. And with respect to courts, they're all over the place. The standard in some jurisdictions is relatively low, so long as you're kind of verifying against your internal records that the information on the credit report is what the records reflect, that's sufficient. Other jurisdictions have found that you need kind of a tailored dispute process depending on the nature of the dispute, which may in some cases require you to take extra external steps to verify the accuracy of the information. The CFPB issued a bulletin on this topic back in 2013, which I believe is very cryptic. On the one hand, they say, consider all relevant information, and then they go on to say, including documents the CRA includes, and the furnisher's own information. So on the one hand, they seem to say, you got to go pretty far, but then they only list with an including, but not limited to, the documentation that you already have in your hands.
And that, Alex, that bulletin came out around the same time that there was enhanced e-Oscar functionality where documents were provided. Yeah. So that creates a scenario, sort of a catch-22, where documents are in hand and they're not looked at. There's automatically potentially not a reasonable investigation.
Yeah, I think that's one thing is clear, that especially now that the CRA's got a lot of heat for not sending the documentation to the CRA, to the furnishers. About 2 years ago, that all was revamped. Everyone had to get ready to accept the incoming documentation from the CRAs, and the CFPB wanted everyone to be clear. whatever you receive from the consumer, the CRA needs to be incorporated in the investigation.
So there's a lot of regulatory expectations, and there has been some recent enforcement activity. For those looking for a clearer understanding, to the extent that there can be one, on the regulatory expectations, the CFPB has put out a number of reports and bulletins. As Alex just mentioned, the 2013 September bulletin is probably the most notable. It certainly got a lot of attention at the time because of those enhanced e-Oscar functionality that was happening at the same time. Also, another bulletin issued in 2014, and then CFPB also started off this whole process by issuing a report that really details the entire history of the consumer reporting system.
Yeah, it's something to note, and I should have mentioned earlier, the 2014 bulletin that's on the right-hand side of the slide. This is actually an important one because this is where the CFPB tells furnishers that deleting a trade line without doing an investigation does not equal an investigation. A lot of organizations thought that, it was consumer friendly to delete the trade line because that's what consumers, that's what the consumers wanted, that's what they were seeking. But the CFPB came back and said that that is not appropriate. There's other reasons for doing the investigation other than just, giving what that specific consumer wants.
Okay, and then also too, the CFPB started a Furnisher Accountability Initiative in 2014. Now, by that time, we'd already heard and certainly were familiar with some non-public confidential investigations of furnishers that ostensibly was the other side of the coin of this. But by December 2014, the CFPB announced it was requiring the major CRAs to provide regular accuracy reports as part of its ongoing examinations. Those reports were not solely focused on the CRAs, but rather on the activities that the furnishers were engaged in and reporting up to the CRAs. So as a result of the routine and regular examinations of CRAs, the CFPB is receiving very specific information about furnisher practices down, in some cases, to the account level. They're using that information then to set regulatory priorities as well as also to decide where they may want to do selective additional scrutiny. Areas where there's high disputes relative to industry peers or in particular categories are the target area, but certainly even just the trend lines generally are being studied and have been reported on by the CFPB. So enforcement, though, continues at the same time in parallel to all of these regulatory changes and expectations that are out there. In one case, the CFPB announced in 2015 against a company called General Information Services, the Bureau alleged that companies violated the FCRA for failing to take the necessary steps to ensure accuracy of consumer information and for including impermissible information in those consumer reports. It was a case where there was penalties and remediation to consumers, which historically you don't always see in these sorts of enforcement actions, and a requirement to revise compliance procedures and develop audit programs.
So quickly, running out of time, in this past September, the CFPB announced two actions against two of the largest debt buyers, debt collectors in the country, PRA and Encore. And in the Encore order, there were allegations under the FCRA if the company didn't adequately investigate disputes because the company was asking the consumers to submit documentation supporting the dispute, which the CFPB concluded was improperly shifting the burden. Under the order, which is also in the PRA order, the companies must review original account level documentation from the original creditor, such as credit card statements, in response to any dispute. This is verbal, written, any dispute, and which goes beyond, of course, the statutory requirements and any other kind of enforcement action to date.
And there's a number of other enforcement actions, too, that we provide a couple slides on for your use after the webinar. These hit on various things, including the 30-day time frame required by law, failure to implement procedures and policies for accuracy of information, and another number of other categories. The key to all of those is that in each of those instances there were both penalties and remediation required, as well as also very specific requirements that in some cases may go beyond existing law, but in many times also illustrate the expectation by the regulator as to what existing law requires. Another source of that information is the CFPB supervisory highlights, including, for instance, in fall 2015, where a number of furnishing aspects were covered. So, Andrew, some key takeaways?
Yeah, and I think we've probably touched on a lot of these throughout the presentation, so kind of wrap them up here and kind of provide some additional best practices from a compliance perspective. The first key takeaway is that the rule applies broadly to entities that report information about consumers to the CRAs. This, cuts across industries, banks, auto lenders, credit card companies, debt collectors, etc. This is the Furnisher rule is something that is certainly seems like a priority for the Bureau and the FTC and other regulators. This is shown not just by the various enforcement actions, but all the different bulletins we've been kind of going over so far.
And one thing to note, I mentioned the settlement with the credit reporting agencies in the spring. One of the requirements in that order is that during their regular reporting, I think every 6 months for the next 18 months, they're required to submit a report to the participating states identifying furnishers that required corrective action. So, they're supposed to monitor now furnishers and the accuracy of reporting from furnishers, and they're required to actually provide a list of furnishers that required corrective action to the states going forward.
And so those expectations continue to evolve, but what we also talked about too, another key important takeaway, is that there's this overlap between the Furnisher Rule, the Fair Debt Collection Practices Act, and UDAP requirements. And so even if you're not a debt collector, there's still these sort of expanded expectations, requirements, and areas for regulatory risk and potential fines and penalties as a result of the CFPB's UDAP authority, as well as the FTC Act. Which is quite broad as well. The result is that just taken in a vacuum, compliance with the Furnisher Rule is complex, but when you add in everything else, it can be very difficult and challenging. So a starting point for compliance, of course, is the compliance management system. Those of you that work in-house at organizations with large compliance departments know this well. For those with small organizations, the key is to have a CMS that is tailored to the individual company, but also takes into account all of the different possibilities, including corrective action and updates, driven by what you're seeing in the dispute categories. So if you're seeing, for instance, a lot of disputes in a particular coding area or in a qualitative manner, there may be some other aspect to not just the individual reasonable investigation you need to do related to that particular account, but some sort of adjustment you may need to make to some other policy or procedure. It can all be quite interconnected. The CFPB particularly is taking advantage of that and scrutinizing that in its supervisory context as well as in investigations. Written policies and procedures, as Andrew commented on earlier, is critical for both facial compliance with the Furnisher Rule as well as also getting it right. The reality is that the policies and procedures are where things start with the Furnisher Rule, but as we said before, it's not where things end.
Right. So the first sub-bullet we have here is about internal controls, and I think having sufficient controls and testing in place is extremely important in this context, and it's one function that can be tested. And so generally, quality checks of information that's been furnished before it's submitted to the credit bureaus and after it's submitted to the credit bureaus to ensure that it's properly reflecting the information in your system of records and that the credit bureaus are assigning it to the right consumers and properly reflecting it on the actual credit reports. So that's, sampling of data against the account information is critical for this specific function. In addition, most organizations that are submitting credit files to the credit bureaus are doing this through some sort of automated program that's been coded into their system who knows how many years ago. It really behooves every organization to periodically review that code and programming that drives the Metro 2 transmissions on a regular basis to ensure that it's properly current, up to date, and reporting what you want it to be reporting. Another area for kind of implementing controls are the rejection or error reports that the CRAs send back to furnishers. There are a number of reasons why certain files are rejected. It's not just dealing with the individual rejections, but also keeping track of trends period over period to make sure you're picking up on any more systemic problems. And then, of course, monitoring disputes and complaints. There's a lot of reasons why you should be doing that. Compliance with the FCRA is just one more. And I'll just note one more thing on vendors. So if you're outsourcing the credit reporting function, of course, monitoring your vendor is a critical component of compliance with the FCRA. But even if you're not letting your vendors credit report, if you do all the credit reporting in-house, think about how what your vendors are doing could impact how your ability to accurately credit report. So one, if you're relying on on vendors to help facilitate the credit reporting function, so the more technology, security type companies, that's a very critical part of your vendor monitoring. But also vendors that you rely on to make sure that the information you're reporting is accurate. And so an easy example is if you are a creditor that is using a debt collection agency to collect on your accounts, if you're doing the credit reporting and you're not getting up-to-date balance information from your debt collectors, you're not going to report the correct balance. And so you need to make sure that those agencies are reporting, up-to-date, current information about that account in order for you to be able to furnish accurately.
And of course, you got to keep an eye out for changes in the evolution in both the law, the regulations, and the guidance that's out there. For those involved in any debt collection activity at all, whether you're a first-party or third-party debt collector or even original issuer or a billing services company, the CFPB's announced notice of proposed rulemaking for debt collection from over a year ago is critical to pay attention to. Regulatory rulemaking is expected in this winter, and as a result, there may be shifts in both what the tea leaves are as well as also directionally where the regulations are related to collection activity and reporting. There's also the rulemakings for payday, auto, title, and other loans, and voluntary disclosures of non-public CFPB investigations, announcements of settlements, and supervisory highlights and bulletins. All of that together is making for a lot to keep track of, for both changes in the law, but also examples of potential issues that perhaps if you had in-house could be issues for your organizations as well. The list that we've given today and the examples that Alex just provided are all ones that are out there in bits and pieces in various places from both experience as well as also in these public documents. And then finally, too, the key, of course, prepare for potential examinations, and you got to focus on the furniture issues. No matter what possible business unit or activity may be implicated, because like payment processing and other functions that happen in the background, furnishing is typically not the primary activity of an organization, but nonetheless it is occurring on a day-to-day basis, almost in real time about your consumers, and as a result of that is a high area of priority for the CFPB as well as the Federal Trade Commission. And take remedial actions as necessary and appropriate. The regulators have said that they'll give credit for that, and the key is to position that and to do that in a manner in which is both beneficial to the consumer and the organization, and is done in a spirit by which the CFPB and other agencies would expect. So for those looking for the CLE code, stand by, but we did receive a couple questions today during the course of the session. Most of them are very specific, so what we'll do is we'll get back to individual questioners offline. Happy to do that, and we see the questions that we received. If anybody has any other questions, please feel free to contact us. And again, we're going to have another webinar on January 12th, 2016 at 2 p.m., the Consumer Financial Protection Bureau Outlook for 2016. That'll cover all the different issues that we expect to see in 2016, as well as also a bit of a look backwards, too, to inform what the future holds. And for an index of articles and presentations on related topics, see our website, venable.com, CFPB publications, those with backslashes. There are several articles related to credit furnishing on the site, as well as also the related issues that we talked about, including CFPB examinations and investigations, as well as also topics related to FTC activity.